Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS. Today I'm going to give you an introduction to the oil market. My goal in this webinar is to allow you to understand the commodity, to understand what moves its price, and give you my view on where the price is headed. So we're going to discuss what oil is, what affects the supply, what affects the demand, what data should you watch in order to follow the market and to trade it, and the role of expectations in particular, and then finally why I expect oil prices to fall further. First, the question is, why should you be interested in oil to begin with? Mainly for two reasons. One, it's extremely volatile. The price fell 75% between June of 2014 and February of this year. That's less than 2 years, only to rebound nearly 70% in 2 months. On average, the price moves 4.7% every day. That's between the low of the day and the high of the day. That's tremendous volatility. It compares with about 1.1% for dollar yen and less than 1% for euro dollar. So as a trader, you're going to have much more opportunities to catch a wave on the intraday move. Secondly, it offers an opportunity to diversify your trading. Now, financial theory says that by investing in uncorrelated assets, you can improve your return while reducing the variability of those returns. That is, by reducing your risk. So you can get higher returns with lower risk. Of course, this won't work if you're trading currencies that are highly correlated with the price of oil, but there are currencies that are not correlated. By trading oil and these currency pairs, you can diversify and reduce your risk. So let's start with a very brief discussion of the oil business, just the whole oil business, how oil gets from the ground to you. First, it's pumped out of the ground either on land or offshore. Then it gets moved to a central storage location, either by rail, by ship, or by pipeline. Refineries then buy the oil and refine it into the products that you actually use, that we use, like gasoline, fuel oil, asphalt for the roads, etc. Those products get shipped to bulk storage terminals. And from there, they get distributed to the retail outlets, and you go to the gas station and fill up your car. So that's a very brief summary of the industry. Now, if you're just to start from the very beginning, if you're interested in buying and selling oil, what should you do? Well, you can't just buy or sell oil like you can buy or sell gold. Gold's an element. Gold is always the same once it's refined, no matter where it comes from. Oil, on the other hand, differs depending on where it comes from. The supply and demand for each type of oil is different, and therefore so is the price. Each oil field produces a different kind of oil, and each kind of oil can be refined into different amounts of the various petroleum products, such as gasoline, jet fuel, or asphalt. Each product then sells for a different price. Now, the price of each oil, therefore, depends on the price of the products that can be refined from it. This is called the netback. Some products have more energy per liter and are less polluting than other products, and so they're more valuable. Oil that can be refined into more high-priced products, such as jet fuel or gasoline, is therefore worth more than oil that's only good for making cheaper products, such as the bunker fuel it's used on ships, or asphalt. Now, the main terms used for describing oil are sweet and sour. This refers to the amount of sulfur in the oil. This really does refer to the taste. In the 19th century, the oil prospectors would taste and smell the oil to determine its quality. Oil can also be described as light or heavy, based on how easily it flows and how dense the oil is compared to water. Now, light, sweet crudes can be processed with less sophisticated, less energy-intensive refineries and made into cleaner and more energy-intensive products than the heavy, sour crudes. So the light sweet crudes are usually more expensive than the heavy sour crudes. Now you can see on this graph how the various kinds of crudes rank in terms of heavy versus light on the x-axis and sweet and sour on the y-axis. Now, because the quality of each crude varies so much from place to place, it's hard to set a price independently for each one. The price is therefore set in reference to a benchmark. That is, there's a few crudes that trade actively in the open market, and a public price is established for them. Then other crudes are priced at a premium or discount to those crudes. The two main benchmark crudes in the world are West Texas Intermediate, or WTI, and Brent. WTI is the benchmark for the U.S. oil market, and Brent is the benchmark for Europe, Africa, and the Middle East, about 2/3 of the world's demand. Now there are other benchmark crudes too, like Dubai crude or Oman, the OPEC reference price, but these aren't traded as actively, and so they're not really used for speculation that much. WTI is a blend of several U.S. oils from, guess, West Texas. Well, Brent actually comes from various fields in the North Sea. Originally it just came from the Brent field, but now it's more of a trading classification. WTI, as I said, is the benchmark for the U.S., and Brent is used for pricing oil in Europe, Africa, and parts of the Middle East. Both of them are light sweet crudes. WTI is a little lighter and sweeter than Brent, and so therefore historically was a bit more expensive, but in recent years the supply of WTI has increased greatly and pushed its price down below Brent. Now a lot of people actually just trade the difference between these two oils. They trade the spread rather than taking a view on the direction of oil itself. But that's the subject for another webinar. Now, if you actually want to buy some oil and take it home with you for some reason, you'd be interested in what's called the spot price. That's the price you might see quoted in the newspaper for oil. The price of oil for immediate delivery out to about delivery in 30 days. The spot markets, oh, I'm sorry, yes, there is a Canadian benchmark too, Canada Select, I think it is, but we don't offer that one. You're right, and that's a very good point. I'll have to mention that in the future webinars. That's also a widely traded crude. And anyway, I'll deal with the questions at the end. So what was I saying? The spot market's generally conducted over the phone, and various pricing services collect the prices and publish them at the end of the day. But that's not really the price that people like us, who are just interested in trading, use. FXPRIMUS offers the WTI and Brent futures price. We have contracts for differences on the futures price. That's because futures are listed on an exchange and they're constantly traded. Two-way prices are publicly available around the clock, so you can buy and sell much more easily. Now with futures, as long as you manage your position correctly, you don't have to worry about where to put the oil. You're not going to get it, especially if you're trading contracts for differences. Now, trading conditions in the WTI and Brent futures markets is pretty similar liquidity, open interest and everything. So there's no big advantage to trading one market over the other. Also, since we use the nearest contract, the difference between the spot price and the futures price isn't that great. Futures prices themselves do have one disadvantage though, which is that eventually the contract matures. For example, the near contract in WTI, the one we base our price on, expires on September 20th. If you want to hold your position longer than that, you'll have to close it out at some point and open a new one. That usually entails a loss, since longer dated contracts tend to have higher prices than shorter dated contracts. To get around that problem, we also offer a contract based on the futures that doesn't mature. Now, sometimes this kind of contract is referred to as a spot price, but technically that's wrong. So, what moves the oil price? First, we're going to talk about the historical pattern of supply. The price of oil, like most other freely traded products, is obviously set by supply and demand, at least in theory. It's very simple. More buyers than sellers, the price goes up. More sellers than buyers, the price goes down. So what happens? Why are people? The increase in the question of why are people buying and selling? Of course, that has to do with the supply and demand, and we're going to look at the supply first. Until recently, the supply of oil was pretty steady in the short term. It takes a long time to find oil and a long time to develop an oil field once you found it. And once the oil wells were pumping, usually a producer preferred to pump all the oil that they could. So, until recently, the majority of short-term changes in output were those that caused a reduction in supply, since it was very hard to have a short-term increase. Power outages slowed production, thieves damaged pipelines, bad weather shuts down offshore oil rigs, terrorists attack oil wells and pipelines. Iran was shut out of the global oil market for years because of sanctions. Libya's oil production obviously plummeted when they had a civil war. And sometimes producers just shut down operations for maintenance. Oil fields also get exhausted over time. Britain's North Sea oil fields, for example, made the country a net export of oil in the 1980s, but now it's a net importer. Now, reductions in supply obviously tend to push up prices. Sudden increases on the supply historically came from only a few places. First of all, of course, when those obstacles or disruptions that I just mentioned end, supply naturally comes back to the old level. That was the main source of sudden increases in supply. Secondly, some countries, most notably Saudi Arabia, kept some supply capacity in reserve. Saudi Arabia did this in order to retain its role as the swing producer within OPEC and within the world oil markets. What's the swing producer? When oil demand increased and prices rose, Saudi Arabia would then increase its production in order to bring supply and demand back into balance and keep prices steady. On the other hand, when demand weakened and prices fell, the kingdom would reduce its output to shore up prices. The reason was that Saudi Arabia, with its huge reserves of oil, always wanted to keep oil prices low enough that the global economy would remain healthy, and also low enough that alternative sources of energy wouldn't be competitive, but they wanted to keep oil prices high enough to maximize revenue over the long term. So they were trying to keep oil prices within that range. Now, fracking changed everything. The world has changed, the oil world changed in recent years because of the development of what's called hydraulic fracturing, or fracking. This is a technique where liquids are injected into oil wells at high pressures that fractures the rocks and releases oil and natural gas. Actually, the technique isn't that new, but it just wasn't widely used before. However, combined with new developments that enable operators to drill wells horizontally, something that was never possible before, fracking has enabled producers to access oil that they could never have accessed before. So, as you can see here on the left, a typical vertical oil well intersects the oil deposit over only a small part of its length. A horizontal well has much more surface area exposed to the oil deposit, and so will produce much more oil, although it'll also exhaust the deposit more quickly. The picture to the right shows how if you fracture the rocks, even more oil will flow into the well, and the well will be exhausted even faster. Now, the combination of fracking and horizontal drilling plus other technological improvements has boosted U.S. oil production by 80% and turn North America, and I include Canada in this because these technological improvements have had a big impact in Canada too. They've turned North America into the world's largest oil producer. I'm actually not including Mexico in North America in this case. The United States and Canada now produce around 40% as much as all the OPEC countries combined. This has eroded the power of OPEC and Saudi in general, and Saudi Arabia in particular, to control the supply of oil and to control its price. It's also created a nightmare for many U.S. residents, as fracking causes earthquakes and pollution, but that's a different story. Now, what's different about fracking? Why has it changed the industry? Fracking is qualitatively different from other methods of drilling for oil, and it's really changed the nature of the oil game. Previous methods of producing oil were heavily capital intensive. They took a lot of money and it took a lot of time to develop an oil field. Fracking wells, on the other hand, are cheaper, faster, and easier to turn on and off. They've turned oil production into almost an assembly line process, with the resulting increase in efficiency and, just like any other manufacturing process, drop in price. Now this has changed the elasticity of supply for oil. As I said before, traditional wells take a lot of money to get up and running. Oil producers therefore don't like to turn them off even if the price falls, since the marginal cost of pumping oil is really low once the flow is started. Fracked wells, on the other hand, are cheaper to start but cost more to maintain, so their owners are more willing to turn them off when prices fall. Supply of oil, at least in the US and Canada, therefore reacts much more quickly to demand. In addition, fracking gives rise to a large number of what's called drilled uncompleted wells, duck wells. That's without a K. These are wells that have been started, or spudded as they say in the oil business, but not completed. They can be brought onto production within about 4 or 5 months if the drilling company believes it would be economical to do so. So I looked into this was a couple of months ago. I read that there were some 4,000 of these duck wells in the US. It represented a potential 1 million barrels a day of production that could, in theory, be brought on stream relatively quickly. Of course, it's quite theoretical, as they couldn't, there just aren't the people to start them all at the same time. Anyway, market participants monitor what's called the frac log. That's a combination of fracking and backlog to anticipate possible near-term increases in output. How quickly can U.S. producers ramp up production if they want to? So this increase in supply from fracking and this overhang is one of the major factors that has pushed oil prices down over the last year or so. Perhaps most importantly, it's eroded or even destroyed the importance of OPEC in stabilizing the market by increasing the amount of oil that non-OPEC producers make and enabling the U.S., not Saudi Arabia, to act as the world's swing producer. So that's the story about the supply side of oil. Now let's talk about the demand side of the equation. The demand for oil varies regularly according to the seasons, first off. In the summer, people go on vacation, and at least in the U.S., they drive a lot more. In the winter, people have to heat their homes. This causes a destocking cycle for oil as refiners build up inventories of gasoline in the spring and heating oil in the fall ahead of these peak demand periods. It also causes changes in the relative prices of oil because light sweet crude is better for refining into gasoline, while heavy sour crudes can be used to make heating oil. So naturally, any disruption to the usual seasonal patterns will cause a disruption to the usual pattern of consumption. For example, unusually warm winter weather can cut into demand for heating oil in the winter, while unusually hot weather in the summer can increase demand for air conditioning and therefore electricity, and the oil to run generating. So weather reports are required reading for the aspiring oil trader. Oil demand also varies with economic growth. When the economy is booming, industry uses more energy to produce more goods. Railroads and trucks use more oil to ship those goods, and people tend to drive more when they've got more money. In recessions, however, it all goes on to reverse. You can see in this graph, which shows where the line is the year-on-year change in oil production, and those bars show recession periods. You can see how oil tends to fall going into recessions and rise during expansions. This is why oil prices respond to economic indicators, particularly economic indicators of overall economic conditions, such as the GDP figures or the purchasing managers indices, the PMIs, as well as things like consumer sentiment and retail sales. Now, similarly, economic developments caused a large increase in demand for oil over time because people with higher income and a higher standard of living tend to use more energy up to a point. For example, Chinese auto production. China now makes around 24 million cars and trucks a year. This is 5 times what it produced 10 years ago, and it's about double the U.S. auto production. As China's gotten richer, more Chinese people have bought cars, and they drive cars, and they use gasoline in their cars. So that's a huge increase in the demand for gasoline that's caused by an improvement in the country's standard of living, a rise in their standard of living. On the other hand, technology is starting to make inroads into demand in the developed countries. It's, it works after a point, it works in reverse. For example, in some countries, solar and wind energy are replacing oil for generating electricity, while the internet shopping has reduced the amount of driving people do. So while economic progress in developing countries means greater use of energy and more demand for oil, in the developed countries, technological progress can have the opposite effect. Now, of course, demand changes with the price. Like most things, people buy more when it's cheaper and less when it's expensive. This means oil prices are mean reverting to some degree, although it takes time. They say in the oil business that high prices cure high prices and low prices cure low prices. What that means is that when prices rise, supply increases, as we just saw from the fracking, and demand decreases. That pushes the price back down. On the other hand, when prices fall, oil producers pump less oil and consumers use more. That pushes the price back up. So, what are the major oil-producing countries? As I mentioned, oil responds to indicators of economic conditions. Note here that the U.S., Europe, and China alone, these three account for nearly 50% of world oil use, and with Japan that makes it over 50%. So the oil market's particularly sensitive to indicators of growth in those regions. Russia, Brazil, and Saudi Arabia are also surprisingly large consumers of oil, but they're also large producers too. So their economic activity doesn't make such a big difference to the global price of oil. It would if their domestic consumption got to be so big that they have to divert oil away from exports. Now, how do we evaluate the supply and demand balance? It's hard to gauge the supply directly. There is data, but accurate data is on the supply. The global supply is available only with somewhat of a lag, and demand is even harder to gauge too. There's accurate demand, there's accurate figures for demand from the developed world, but not so much from the developing world. Now, nonetheless, even if you can't measure supply that accurately, and you can't measure demand that accurately, you can measure the difference between the two, the balance of supply and demand, by looking at inventories of crude oil as well as inventories of oil products. If you think of it this way, in effect, oil goes in the top of the tank, that's the supply, and oil comes out of the bottom of the tank, that's the demand. So if the amount of the oil in the tank is rising, then supply is exceeding demand. If on the other hand the amount of oil in the tank falls, then demand exceeds supply. So this is why the weekly inventory figures from the American Petroleum Institute and the U.S. Department of Energy's Energy Information Agency are closely watched. Now, as I showed you in the table before, the U.S. accounts for around 20% of world oil consumption just by itself. So its supply and demand for oil is therefore the single most important factor in determining the price. Now, since these weekly inventory figures are the most important high-frequency news to affect the oil market on a regular basis, I'm going to spend some time discussing them and the difference between the two. First, there's the API report. The American Petroleum Institute, the API, is a national trade association for companies in the oil business. The API produces its weekly statistical bulletin, which reports on production of oil and the 5 most important petroleum products. It also includes information on inventories. Now, the report's published every Tuesday afternoon U.S. time, and it covers the week ended the previous Friday. Now, one key point, this report's available by subscription only, so the numbers aren't widely distributed to the general public. However, everyone involved in the oil business subscribes, so the data does move the markets. Here's a copy of the report. The circled figure is the most important one to the market. That's the change in crude oil stocks, the weekly change in the crude oil stocks. Secondly, we've got the U.S. Department of Energy report. The Energy Information Administration, the EIA, is the Department of Energy's statistical and analytical agency. It publishes the EIA Weekly Petroleum Status Report. This gives similar data on the supply of oil, actually more extensive data on the supply of oil, both domestic oil and imports. And it also gives the level of inventories of both crude and refined products. This is published every Wednesday for the week ended the previous Friday. So here's the part of the EIA report, weekly report, that crude oil traders are interested for the same week as the API report that I just showed. Now, in both reports, oil market participants focus on the change in inventories from the previous week. It's measured in thousands of barrels in the API report, millions of barrels in the EIA report. A negative figure like we have now shows a drawdown in inventories, which suggests that demand for oil exceeds supply. As a result, prices would usually move higher. On the other hand, an increase in inventories would tend to push prices lower. Now, as you can see here, there's something called the Strategic Petroleum Reserve, the SPR. That's the U.S. government holdings of oil. The market usually ignores any changes there. Now, these are two reports for the same week. As you can see, the API had reported a drawdown of 7.2 million barrels a day. The EIA reported 7.4 million barrels. It's close, but they're not the same. Why is that? What's the difference between the two? Well, both of these organizations use the same definitions, and they cover the same time periods. Now, there are some differences that arise because the two use different statistical methods to estimate data from companies that don't reply to their surveys. But basically, the difference is that the API report comes out one day earlier, as I said, but it only covers its approximately 550 members and a few other companies that agree to report it to it. On the other hand, by law, all oil companies in the U.S. have to report their information to the EIA. So The API report is earlier, but the EIA report is, in theory at least, more complete, and therefore it's considered more authoritative. In any event, the market reacts to the EIA data because, as I said, it's perceived to be more accurate, although the API would argue that it's not. And perhaps more importantly, since it's publicly available, many security firms produce forecasts for it. So that provides a market consensus to judge the figures against. Of course, these market consensus is produced before the API data comes out. On Tuesday afternoon, the API figure comes out, and that might change traders' expectations for what the EIA data the next day is going to be. Now, the EIA data also includes initial estimates for U.S. oil production. This data is quite important, too. More accurate figures for production are available sometimes later when the monthly figures come out. This is also important, as we'll see later. Now, the API and EIA figures usually match in direction, but not necessarily in the magnitude of the change. They would probably both say, oh, well, from the beginning of 2015 until the end of March 2016, the change in inventories in the two matched, or the direction matched 86% of the time. Or looked at another way, it means the direction of the two differed about once every 7 weeks. Once every 7 weeks, one report would say inventories were up and the other was down. The other 6 weeks, they would at least agree on the direction. As for the magnitude, the two differed by over 1 million barrels 60% of the time, and over 3 million barrels 24% of the time. Those are pretty big differences. Now, how do the figures affect the oil markets? Here in this graph, we can see the change in the EIA crude oil inventories. That's the black line, or the blue line, and it's reversed against the change in WTI price, which is on the left-hand side. As you can see, when inventories are increasing, that's when the orange line is going down. And this slide, it means you can see that WTI prices tend to decline too, and vice versa. That's because rising inventories, as I said, show that supply of oil exceeds demand. Now, the seasonal nature of the oil market means that inventories have to be evaluated in relation to the average for that time of year. They're going to be different in the summer than they are in the winter. So usually investors compare the current level of inventories to the average for that week for the last 5 years or so. That's what we've got a graph here where showing the normal range for the week over the previous 5 years and total inventories. As you can see, inventories are still well above normal levels nowadays. Now there's one quirk in the U.S. oil inventory figures. The main loading point for WTI in the U.S. is Cushing, Oklahoma, this little city in the middle of Oklahoma with about 5,000 people. You can see it here on this map, which the map shows the major oil pipelines in North America. Cushing is the place with the white arrow pointing to it. This is the main transshipment point for oil in the U.S. Market participants watch inventories at Cushing carefully, separately from the national inventory figures. The problem is that the storage tanks in Cushing aren't infinite, and in fact they're getting pretty full nowadays. The price of WTI can sometimes fall independently of the overall supply-demand picture if it looks like Cushing is running out of storage space. People aren't going to buy oil if they don't have any place to put it. Now, oil can also be stored offshore on tankers, which makes the price of chartering tankers an indication of conditions in the oil market too. And there are actually crude oil storage futures if you're ever really interested in the market. Those are for storage in Louisiana. Investors also watch the Baker Hughes rig count, which comes out every Friday evening in the U.S. The Baker Hughes company actually counts how many oil and gas rigs, the towers that are used to support an oil drill, are in operation in the U.S. and Canada. Data on other countries is available monthly from these guys. The idea is that when the number of oil rigs increases in a few months, the amount of oil being produced is likely to increase too, or vice versa. For example, the number of oil rigs in use in the U.S. collapsed from about 1,600 in October 2014 to only 316 back in May. That's an 80% decline. That went along with only a 10% decline in the amount of oil being produced, by the way, because of improvements in the technology. But the rig count has started to go back up again, as you can see, which signals to the market that more oil is coming. Now, historically, the number of rigs led output by around 18 months, but because of the improvements in technology, enables drillers to drill more wells with one rig and get more oil out of each well. This correlation is breaking down. Other things that move the market with less regularity, as I said, the weekly inventory figures from the IEA are preliminary figures about 2 months after the fact. They also publish a monthly figure that's more accurate. These aren't as market affecting, but they do contain significant information. Other regular news items are the International Energy Agency, a Paris-based agency of oil-consuming countries, which puts out a monthly report on oil, and also OPEC itself puts out a monthly oil report. Both of these include forecasts for supply and demand. In particular, changes in the IEA's forecast for global oil demand can move the market. And that brings us to the next part of this talk, which is expectations. Now, I know I said earlier that the price of oil is determined by supply and demand, but actually that's wrong. If you traded solely on, if you could get an accurate picture of supply and demand and you could trade solely on that, you'd be likely to lose money. According to some researchers at the European think tank Bruegel, since the financial crisis of 2008, the factors affecting moving the price of oil have changed dramatically. Nowadays, supply and demand, actual supply and demand changes account for only about a quarter of the change of prices. Most of the change of the price of oil is due to changes in expectations. Oil is trading a lot like a financial product in which the role of speculators has become dominant. So this graph shows the Bruegel's estimate of what moved the price of oil. It's a contribution of expectations in green, changes of supply in blue, and changes in demand in red. So okay, now we have to ask what change affects expectations. As I said before, one of the major points I made before is that economic indicators move the oil price. That's because of this role of expectations. Market participants form views on future demand for oil by estimating what the future level of economic activity is going to be. And that's why oil prices are sensitive to indicators such as GDP and the Purchasing Managers' Indices. Weather and other factors that could disrupt supply or change demand in the future are big factors too. The main factor for expectations that we haven't discussed yet is geopolitics, and particularly the geopolitics of the Middle East. Let's face it, a lot of the world's oil is located in countries that aren't among the most stable in the world. Iraq, Libya, Nigeria, which is not in the Middle East, that's Africa, of course, for example. Investors are constantly watching for signs of trouble in these countries that might restrict supplies. Now here's a graph, or a map of where oil is produced around the world. The darker the color, the more oil is produced. And here's a map of global instability. The darker the color, the more unstable. Do you notice any similarity between the coverage of these two? It's, yeah, there's a lot of similarity. So people are always trying to look for whether there's going to be any trouble in these countries, political trouble, or whatever. Also, geography plays a very large part in this. Many of the large Middle Eastern oil producers can access the sea only through the Persian Gulf or the Arabian Gulf, depending on which side of it you live on. Saudi Arabia's main loading port, for example, Ras Tanura, is on the Gulf side. Now this narrow Gulf is only 56 kilometers wide at its narrowest point, the Straits of Hormuz. And the shipping lane of the Straits of Hormuz is only 3.2 kilometers wide. This is also the world's largest source of oil. In 2011, some 20% of the world's traded oil sailed through that 3.2 kilometers wide channel between Iran and Saudi Arabia. And if you remember, think about it, Iran and Saudi Arabia are now more or less at war. They're on a proxy war in several places. So you can easily see how fragile the transportation network for oil is and how important geopolitics is for the supply. Now there are other choke points too throughout the region. For example, when the Egyptians overthrew President Mubarak in 2011, oil prices shot up out of fear that the Suez Canal would close. And also the Suez Canal has an oil pipeline running alongside it. And that might be, there were fears that that might be closed. Now the point is, it's not necessary for events to cause any disruption to the supply of oil. It's just enough for there to be a threat that they might cause a supply, and that's enough to send the price higher. Oil refiners will rush to buy oil and put it in storage so they'll have enough supplies even if oil prices become unavailable. Other refiners will hedge their risk by buying oil futures. Speculators like you will buy oil futures expecting to be able to sell them in the future sell them back to the market at a higher price. And that will naturally push up current prices as well. In short, traders wishing to speculate on the price of oil have to consider all the factors that might possibly at some time in the foreseeable future affect the price of oil and trade accordingly. Now, I'd like to change gears for a second. That's the outlook for that's the nature of the oil market. I'd like to come back to the FX market for a second and talk about the connection between oil and FX. There's actually a very close connection between the oil market and the FX market. Several reasons for this. First off, the main connection is that for some countries, particularly Canada, Norway, and Russia, oil is their main export. So a change in the oil price has an immediate impact on their terms of trade, the value of their exports as compared to the value of their imports. So it has an immediate impact on their currency. On the other hand, a lot of other countries, particularly emerging market countries, are net importers of oil. So their terms of trade and their current account balances are affected by the price of oil too, but in the opposite direction, of course. Now, oil prices, as I said, tend to move along with economic activity, and so do currencies. That explains some of the correlation between oil prices and currencies. Now, oil prices tend to rise when geopolitical tensions increase, as I said, and periods of geopolitical tensions tend to be periods of risk aversion. That has implications for currencies, particularly the safe haven currencies, the yen and Swiss franc. Oil is usually paid for with dollars. It's priced in dollars. So when oil prices rise, global demand for oil, for dollars usually rises. Now these dollars aren't recycled back to the original countries in the same ratio that they came. For example, Eurozone countries may have to buy more dollars to pay their oil bill with Saudi Arabia, but the Saudis won't necessarily spend those dollars in the Eurozone. They won't necessarily convert them back into euros and spend them in the Eurozone. They may choose to save some of them in dollars, and that would tend to increase the demand for dollars therefore pushing the dollar price up. On the other hand, since oil is paid for with dollars, the price of oil tends to fall when the dollar rises because it becomes more expensive for countries outside the U.S. to buy oil. The reverse also happens too. Other dollar-denominated commodities such as gold show this kind of behavior as well. The oil market is therefore very important for FX investors to watch. Here I have a table of the correlations between some of the oil currency pairs and oil. Earlier I showed you a table of the currencies that were not correlated very highly with oil price. This table shows those pairs that are most closely correlated with WTI and with Brent, including also some unusual currency pairs that you might not expect. Notice that the Canadian dollar, the Russian ruble, Norwegian krone, Mexican peso, and the Australian dollar are the most closely correlated. Australia isn't a particularly big oil exporter, but it does export coal. The price of coal depends to some degree on the price of other energy sources too. Probably more important though is the fact that Australia's economy is closely tied to that of China, and expectations for Chinese economic activity tend to move the oil price. The yen, on the other hand, seems to weaken when oil prices go up in the cross rates, CAD yen and Aussie yen, more than in dollar yen or euro yen. That could be because since the Fukushima disaster, Canada shut down its nuclear power stations and had to import large amounts of oil, which reduced its current account surplus. So my view on the oil price, I've been saying for some time when it got over $50 a barrel that I thought it would fall. It is falling. I expect it to fall somewhat further from here for a variety of reasons. First off, Brexit has increased uncertainty in the world and will probably reduce investment as a result. That means less growth, and that's negative for oil. The dollar is rising, which as I mentioned, is bad for the oil price. Third, I think this is very important to note, when oil prices were around $50 a barrel, that was enough for U.S. shale oil producers to start pumping oil again from the frac log. As I showed you, for example, the rig count started to go up again. So, and we've started to see an increase in U.S. oil production. Remember what I said about high prices cure high prices, in part by increasing supply. Now, several of the disturbances that pushed oil prices higher earlier in the year are over. The Canadian wildfires have died down. Canadian production is back up again. And Nigeria has come to some agreement with some of the protesters, some of the people trying to disrupt supply there. Iran and Saudi Arabia both want to produce more oil in the future, and they're planning to. And finally, a very interesting point, U.S. demand might not be as strong as people think. Remember, I talked earlier about the monthly figures from the Energy Information Agency. While the weekly demand, the yellow lines in these graphs, show demand rising, the monthly data, which is more accurate, is headed down. It's headed in the opposite direction. So far, we only have monthly data up to April, so we don't know for sure. But in the past, when the two diverged, it seems that the weekly data came into line with the monthly data, not the other way around. Note that we did see an increase in inventories in the latest week, and gasoline inventories are particularly high. So I think we could be in for a rethink about where demand is, and therefore a rethink about prices. So that's it for me. I've covered what the oil market is, what oil is, what moves the market, and what the connection between oil and the FX market is, and where I think oil prices are likely to go. And now I'd like to throw the discussion open for questions. Okay, someone was asking about Canada earlier. Yes, Canada didn't used to be a major producer of oil, but because of the improvements in technology, it's managed to get what's called Canadian Select, produce a very heavy kind of oil. Oil exports to the U.S. now account for about 24% of Canada's total exports. So the Canadian dollar is probably I'd say the most liquid of the oil currencies. If you're interested in trading oil in the currency market, I think the Canadian dollar is probably the currency to focus on. One question I've heard that oil is a seasonal commodity, and for the past 15 years it's always risen at the end of January each year. In fact, it happened again this year. Well, I don't know. As I said, the demand for oil is seasonal because of this stuff. Yeah, because people heat their own homes in the winter and they drive around in the summer, and the relative prices certainly would change, and there's a stocking and destocking cycle. I've never actually looked into whether there was a seasonal pattern to prices overall, because although there is the seasonal pattern, but also overlay that you have over years changes in the supply as new supplies come in. That's a very interesting question. I've never looked into that. I'll have to try and see if there's a seasonal pattern. Thank you. If there's a reliable seasonal pattern to the price. It certainly did. The price certainly did rise earlier. It was rising in January and February. Oh, and here's a question: how is it affected in the southern hemisphere, where of course the seasonal pattern would be the opposite? I think the U.S., China, and Japan and the Eurozone are all North American countries, so they play they're really their activity is really what determines the pattern. India is coming into play, but yeah, the southern hemisphere countries just simply don't have as much of an impact on the demand for oil as the northern hemisphere do. How much do I expect the price of oil to come down, and when? Well, let me tell you that the main rule of forecasting is you can forecast the rate but not the time period, or you can forecast the time period but not the rate, because people can catch you out if you forecast both. They can find your mistakes. Having said that, I don't think prices would come down much further than the mid-30s or maybe low 30s. That was basically the bottom that we saw before. At around $30 a barrel, U.S. producers start turning off the taps. The U.S. banks start turning off the credit to the producers. I didn't get into this, but the fracking companies tend to be very fragile financially. They rely on bank loans, unlike the big oil producers, the BPs, the Exxons, which finance their money, everything out of their own money, their own cash flow. The frackers need to go to the banks, and when the oil price is low, the banks won't lend them money. And so I think below $35 a barrel, the banks are going to be hesitant to lend money to these guys. They're going to have to turn off the taps. It'll be hard for them to produce. So I don't see the price getting much lower. Now, what if Libya started to export its oil again? Yeah, that's a very good question, because Iran is, for example, is determined. It said specifically it wants to get its exports up to where they were before sanctions, which is another 1 million barrels a day. And Libya, too. Libya is way below where it was before the civil war there. And that would just flood the market with oil, and yeah, I think then we'd see prices back down below $30 a barrel, if they could do it in a short period of time. But Iran seems more possible than Libya. I'm not an expert on Libyan Libyan politics, but they still seem to have a lot of trouble politically and a lot of trouble managing their infrastructure. But Iran is determined to get their production back up. And Saudi Arabia and Kuwait too. They've been, if you look at the rig count, they've been in Saudi Arabia and Kuwait and the UAE have been increasing the number of rigs that they're using slowly but surely. And it seems that they are determined to increase supply later on this year. So come on, September and October, I think we could see an increase in supply from the Middle East. Any thoughts on the yen outlook tomorrow? Well, that's not the topic of this webinar, but I can never resist an opportunity to talk about the Bank of Japan since I've lived in Japan for 18 years. I think they're going to stand pat. I don't think they're going to move. A lot of people think that they're going to increase the bond purchases or cut rates further, but the G20 meeting emphasized the role of fiscal policy as opposed to monetary policy. And that's why I think Japan is coming out with a 28 trillion yen fiscal package, and I think they will try to hold, the Bank of Japan will try to hold their policy stable while they emphasize this fiscal package. Once they see the fiscal package and see the impact, maybe later this year they might do something, but I don't think they'll do anything, and I think the yen will strengthen as a result. I think dollar yen will come down. Right, well, that's about it. Thank you all very much for attending this webinar. If there are any questions, please, I'd be delighted to get them. I only know what to write about if I get a question, and finding a good question is a lot harder than finding a good answer. So any questions you have or comments, please let me know. And meanwhile, I hope you all stick with FXPRIMUS, the safest place to trade.